Investing is not a simple undertaking, but when you are informed and take the time to research properly, it can be a rewarding one. Hi there, I'm Kelly Keene, author and personal finance educator, and we're going to take some time here to talk about types of investments on the market, along with some pointers on how you can do your own research before you choose to invest. The 5 types of investments we'll look at are cash equivalencies, fixed income securities, equities, investment funds, and alternative investments. Cash equivalencies are generally secure investments with low rates of return, but that provide you with quick access to your money. These can be bank accounts, money market funds, and term deposits. You may choose to invest in them because you'll need the money in the short term. Cash equivalencies are secure and liquid, meaning the investment can be easily and quickly turned into cash. These options don't, however, help very much in growing your portfolio. Because they're safe, secured, and easy to access, the trade-off is low to very low interest in return. The next investment we're going to look at is fixed income securities. To understand what they are, think of them this way. You are now the lender, and you're lending your money to the government or a corporation, and they're the borrower. Why is this class of investments called fixed income? It's because the borrower pays you a fixed interest rate until eventually repaying you the face value at the end of the bond's term or maturity date. That face value you get repaid is what you initially invested. Some examples include government and corporate bonds, guaranteed investment certificates, and treasury bills. Generally, you would invest in these because they are secure, low risk, and provide a steady flow of income with a guaranteed return on investment if you hold them to maturity. However, remember that the trade-off too with this asset class is that the rate of return is relatively low. Next, we have equities. These are also known as stocks or shares, and you are becoming part owner of a business when you purchase them. They may also entitle you to vote at shareholder meetings. Finally, you will receive profits the company allocates to shareholders, known as dividends, but you'll also share in the losses of the company if times aren't good. Common, preferred, and flow-through shares are examples of equity investments. Equities carry higher risk than other options we just looked at, but can also help with building your savings and maximizing your income. To recap, a cash equivalent or fixed income investment is one where you're owed money by a government or a corporation. You get a return on what you lent with a modest form of interest. And an equity is where you own a portion of a company. Investment funds are professionally managed and provide you with a broad selection of opportunities. Basically, your money is pooled into a fund where it is invested in a diverse combination of assets. Because you have a professional money manager buying and selling on behalf of investors in the pool, there are fees associated for that service and expertise. For investors just starting out, those with limited understanding of investing, or if you're beginning with a small monthly amount to invest, these funds may be beneficial to you and the fees for the professional management justified. Just be sure you know what those fees are and that you're comfortable paying them. Exchange-traded funds, mutual funds, segregated funds, and money market funds are all examples of investment funds. These investments are also great options because they offer built-in diversification, professional management, and are easy to both buy and sell. Finally, there are alternative investments like private equity, derivative contracts, hedge funds, and commodities futures. These all sound complex, and quite frankly, they are. They're generally more suited to experienced investors because of their complexity and risk profile. one last step before investing is researching the investments themselves. No matter who recommends the investment, it's important to do your own research before you decide to invest. Being an informed investor is one of your best defenses against making an unsuitable investment, or worse, investing in a scam. You should check registration of the person or company offering the investment. Securities regulators will only register firms and individuals if they are properly qualified. The website on your screen is a free service to check registration. Also, check for any disciplinary history. The Canadian Securities Administrators Disciplined List and Cease Trade Orders database can both be checked to see if disciplinary decisions or cease trade orders have been issued against individuals or firms. You should also review company materials. They teach you a lot about investments and companies that issue them. Prospectuses, annual and quarterly reports, and other filings made with Canadian securities regulators can tell you if a company is gaining or losing money and why. These disclosure documents are required to be filed on sedar.com and will also be available on companies' websites. Finally, review other sources of information. You can get a lot of useful information from company websites, analyst reports, business and investment news, and searching the internet. Remember that these sources can be biased or opinion-based. Always be critical of what you find and verify any facts. In addition to checking on your own, you can also seek advice from an independent third party. Hopefully, this has given you some information to get started looking at investments and researching them. For more information on investment types and how to research investments, check out the ASC's webpage. Knowledge is power. Before investing, check first.ca.